Assalamualaikum warahmatullahi. Welcome back to Sada Education. Uh, our topic today is about the risk-taking behavior in Islam. And when the Quran has prescribed al-bay' over riba, it implies that the character of al-bay' is that of a risk-taking character, in the sense that when we conduct a sale, we require some kind of capital investment, and that capital will be put at risk because there is no guarantee that the merchant is able to secure a profit, as the outcome of sale is dictated by the market forces. Unlike riba, where the income or profit from the loan is dictated by the contract of the loan rather than the market movement, and therefore the two big distinction between riba and al-bay' is that al-bay' is based on a risk-taking activity, whereas riba is driven by a risk-avoiding activity. So it is well known that the Sharia promote risk-taking based on the two legal maxim, al-ghorm ghuni, with profit come loss, and then al-kharaj bidaman, profit is accompanied with responsibility. So this risk-taking behavior is fundamental in Islamic finance, and we do not want the Islamic banking and finance to be modeled based on the risk-shifting modality that we find in conventional banking. Because when risk is shifted from the bank to the borrowing party, then risk-taking is eliminated. And that is not in line with the Islamic law or Sharia. And as I say, we know that risk-shifting is the norm in conventional banking. And for the Islamic bank to earn profit, to earn lawful and legitimate profit, so it cannot be driven by a risk-shifting behavior that eliminate risk-taking, because this can lead to riba. So one example that we can use here is illustrated in this diagram. We have on the right a deposit agreement, and then we have on the left here is a loan agreement. As you know, that bank is the middleman that transfer the flow of funds from the deposit market to the loan market. So the deposit market is a surplus market, whereas the loan market is a deficit market. But we can see that in the conventional deposit agreement, for example, the placement is at 10 million and the interest rate is set at 3%. So this is the cost of fund to the bank, and it is a 1-year facility for deposit. And the interest income generated from that placement would be 10 million multiplied by 3%, multiplied by 1 year, that would be 0.3 million. And then the debt created from the deposit, meaning that the money that the bank owe the depositor would be 10 million of the principal amount plus 0.3 million of interest, and therefore the total debts arising from the deposit will be 10.3 million. So it means that the bank owes depositor 10.3 million on the placement date, right, which is redeemable at maturity. So at maturity, then the depositor will be able to redeem the total deposit plus interest. And we can see that depositors enjoy some kind of deposit appreciation. That is the increment of deposit from 10 million to 10.3 million without taking any risk. So this is the ribawi, characteristic, where the interest is acquired without the taking of risk. And then when the bank uses the deposit fund to make a loan, any loss from the loan in case of default will be absorbed by the bank and not the depositors. So the depositors themselves do not take any risk, but they enjoy some kind of deposit appreciation. Thus, we can see here that in the deposit market, the risk in the deposit is shifted to the bank. So the depositors will enjoy a deposit appreciation, and that danger of loss to the deposit due to the default, that danger of loss will be carried by the bank. And when we look at, so that is how risk in deposit, which is a loan that we give the bank, is shifted from the depositors to the bank. And when it comes to the loan agreement, say the loan of the same amount of 10 million, but now this is a loan, so the tenure will be much longer, let's say 5 years. And the interest rate or the loan rate is now at 10%, which comprise of the cost of fund of 3%, which is the deposit rate, plus the interest rate on the risky loan, which is 7%, and meaning that there is an interest charge on based on the default risk, right? There's a finance charge on the default risk of 7%, and the interest margin will be equal to 10 million multiplied by 10% multiplied by 5 years, and that will be 5 million. So now the debt owed by the borrowing party will be 10 million plus 5 million, which is 15 million. So when the customer, so in the loan agreement, the customer owes the bank $15 million on the day when the loan offer is accepted. So based on the loan rate of 10%, we can see that 7% of the loan rate represents the finance charge on the default risk, which implies that the default risk is now shifted from the bank to the borrower. Hence, the customer pay for the expected losses from defaults. So in essence, bank does not carry any default risk, as the risk has been factored into the loan rate. So we got this risk shifting transaction from the depositors to the bank. So when risk is shifted from the depositors to the bank, depositors do not carry any risk, and yet they enjoy the deposit appreciation. And when the bank shifted the risk of default to the borrowing customer, so the bank does not face risk of default, despite them enjoying some kind of loan appreciation from 10 million to 15 million. So this is this is a norm in conventional banking, and therefore we would like to see the Islamic bank to operate their business based on a risk-taking principle, whereby it would not warrant any kind of risk-shifting behavior, because once the risk is shifted from the bank to the customer, the bank is no longer a party that is taking risk, and therefore the earning generated from the business is questionable. And therefore we would like to see more discussion on this matter. Risk taking, risk shifting, risk sharing, very, very interesting issue that should be deliberated by the academia and by the Sharia scholars, so that we can really understand that risk taking is the fundamental value in Islamic banking, and risk shifting should not be the way to do business, because if it does, then basically we are following the modality of conventional banking. So thank you very much. We will discuss further Inshallah, I'll see you. Assalamu alaikum warahmatullah. Thank you.